Good morning, everyone. Welcome to Phillip Securities Research Morning Call for the 27th of September 2021. For today, we'll be touching on Facebook, Starhub. For Phillip on the ground, it will be ComfortDelgro, Asian PayTV, and Qian Hu Corp. For the macro outlook, there'll be the FOMC highlights, S&P 500 dollar index, gold, and the Singapore weekly. Next slide, please. So I'll begin this with coverage on Facebook with the title of Capitalizing on Continued User Growth. Next, please. We're initiating coverage on Facebook with a buy rating and a target price of $424 US dollars, with the last close price of $352.96. So a brief background about Facebook. It was founded in 2004, and it is the largest social media company in the world. As of end FY20, there were 3.3 billion family monthly active people. So this metric, MAP metric, is described by Facebook as any user who has registered or used one of the family of platforms that Facebook currently has in the last 30 days. So the portfolio includes Facebook, Instagram, Messenger, WhatsApp, and Facebook Reality Labs, which is their VR department. So touching on revenue, 98% of the revenue comes from advertising, so a majority of it will come from your targeted ad placements. For payments and others, it would be transaction fees from their payments platforms, as well as hardware sales of VR technology, so like Oculus glasses. In terms of geography, 49% of revenue comes from US and Canada, 24% comes from Europe, 18% from APAC, and 9% from the rest of the world. So revenue came in at 86 billion for FY20, and it's expected to hit 138.8 billion by the end of FY22, growing at a CAGR of 17%, on the back of increasing user growth and ARPP, which we will touch on later on. First half for FY21 revenue came in at 55.2 billion. For PATMI, FY20 registered 29.1 billion and is projected to hit 44.7 billion by the end of FY22, growing at a CAGR of 15%. First half FY21 PATMI was 19.9 billion. So usually in the second half of the year, we see stronger revenue, just based on the seasonality of how advertising works, and especially due to the festive season in November, December. Net margins came in at 34%, which is slightly below their 5-year average of 35%. But for first half of FY21, net margins were 36%. Next slide, please. So we have three investment theses. Our first thesis would be Facebook's expanding user base and value to its advertisers. So for FY20, Facebook recorded 14% year-on-year growth in monthly active people, which I spoke on earlier, and a 17% growth in average revenue per person. So average revenue per person is basically the revenue received in a quarter divided by the average number of users that Facebook has from the beginning to the end of the quarter. And then for the full year, we just add up all the quarters. And this 17% growth in ARPP is led in part by increases in worldwide digital ad spending. And we expect dollar spend for this to almost double from FY20 to FY24 on the back of shifts in marketing preferences. So a little bit more about ARPP is that since most of their revenue is generated from ad placements, the way that it works in Facebook is that Facebook doesn't actually put a price on their ads. It's actually left to an open bid system. So the price is basically decided by supply and demand of marketers, which we see is quite a unique concept for advertising, because it doesn't really put a cap on how much revenue they can generate from their ads. So the strong growth in MAP and ARPP show Facebook's ability to attract, retain, and commercialize users on its platforms. We do expect a slight slowdown in MAP growth to about 8 to 10% year on year, just due to the increase in competition from other platforms, as well as an increased saturation of active internet users that are already on Facebook. We do also expect ARPP to increase 22% year on year on the back of tailwinds from a recovering advertising market. So just a bit of context, FY20 was quite a poor year for advertising, just basically due to COVID and a lot of restrictions like lockdowns in the whole world. But we expect this to kind of start picking up moving forward as there's a lot of shift in consumer marketing behaviors and more businesses go online. Next, please. So for our second investment thesis, we expect Facebook to capitalize on its increasing commerce activity as well as in AR/VR technology. So currently, commerce is actually one of Facebook's fastest growing verticals, with more than 200 million small businesses leveraging on the company's reach and tools to grow their business. So most of their tools are actually free to use, which is quite attractive to a lot of small businesses. We view this as a huge opportunity for Facebook to develop a new revenue stream to complement its existing advertising business. So recently, Facebook actually introduced WhatsApp Pay in Brazil at the end of 2020, and recently in India, Q2 of 2021. And it's sort of their entry into the payment sector, and I guess we'll touch on it a little bit later. So we also see this as quite an important strategy for Facebook because it's an expansion outside of advertising, which reduces their reliance on advertising revenue. So Facebook has actually put plans to develop shops into an all-in-one touch point for their users to browse and interact without third-party diversions, so similar to other e-commerce platforms. Currently, what happens is that businesses are able to kind of launch and put up their merchandise on shops for users to browse. But the moment the user clicks on one of these shops or one of these merchandisers, is directed to their own actual website. So it kind of leaves the Facebook portal, and once there, the transactions will take place on the third-party website, which is not really what Facebook wants. So it's trying to develop a touch point for end-to-end transactions. So all the way from when the user actually begins to see these merchandise in ads, all the way through to transactions where they actually purchase these ads. Facebook wants to capture all these touch points in the future. They're also doubling down on AR and VR, so touting its future potential as more immersive products than the current web browser experience. We see that the worldwide AR/VR market is projected to expand by 10 times over the next 4 years. And we do see this as a potential market that Facebook is well positioned to capture. So revenue from the payments and others category was up 146% year on year Q1 of FY21. Next, please. Our third investment thesis, we like Facebook's high margin, high cash generation business. So net margins for FY20 were 34%, slightly below its average. But if you compare this to Facebook's nearest competitor, Google, they have about a 25% net margin. So we view this as favorable. Net margins were backed by 80% gross margins and low operating expenses on infrastructure, content, and traffic costs. So the largest cost item is research and development at 21% of revenue, which is in line with Facebook's commitment to spend on product development. Free cash flow, FCF, was growing at a CAGR of 14% over the last 3 years, despite huge capital expenditure programs. And we expect this growth to accelerate moving forward. Next slide, please. So touching on some of the risks involved with Facebook, first of all, would be the antitrust battle with the US FTC. So in December of 2020, the FTC filed a court complaint against Facebook, accusing them of creating a social media monopoly through its acquisitions of Instagram, WhatsApp, and other smaller startups. So this case was initially dismissed by FTC, but by the courts. But FTC actually filed a reworded complaint letter, and it's still ongoing. The second concern would be user data and privacy concerns. So in 2018, Facebook allegedly sold data to a third-party firm, Cambridge Analytica, without consent from its users. And they eventually settled in court with the FTC at a $5 billion fine, I suppose, in 2019. For the third point, which we believe is the most important risk as of right now because it directly affects their business model, changes in third-party privacy settings. So in second quarter of FY21, Apple actually rolled out a new feature for its iOS 14 called App Tracking Transparency, which allows users to restrict data provided to all the apps on iPhones. So this it may affect, or it actually will affect Facebook quite a bit because a lot of their Facebook users actually use the iPhones. And so if these users start to restrict data provided to Facebook, it could affect the effectiveness of the data collected by Facebook for its targeted ad campaigns. And we are actually seeing some of the results from these changes, but to be able to see the full effects, we will only be able to find out the next 2 or 3 quarters. The last point would be on President Biden's corporate tax plan. So President Biden has proposed a corporate tax rate hike from 21 to 28% and has considered imposing a minimum tax rate of 15% on book income and a minimum 21% rate on companies' foreign earnings to ensure that all profits in tax havens are taxed appropriately. Moving on to the valuation, we initiate coverage with a buy rating and a target price of $424 based on our DCF valuation with a WACC of 6.7% and a terminal growth rate of 4% in line with US GDP growth. That's about it for Facebook. I'll pass my time on to Weiren for the FOMC highlights. Thank you.
All right, thank you, Jonathan, for the very, very good highlight on our Facebook. So do tune in with us at 1 p.m. and then Jonathan will share more in depth in the for Facebook as well. All right, and then I'll share the technicals as well. More counters will be covered at 1 p.m. for the US counters. All right, so without further ado, I think FOMC was quite a roller coaster ride. New dot plot chart has been shifted earlier, so hence I think with the tapering expected in announcement in November and then December, they will start it, and then expect some completion of the taper by mid-2022 or maybe Q3 2022. All right. So what's the result? I think bonds I think still trading within a range, although 10-year has spiked up above 1.14%. Equities remain weak despite a rebound, as we have not seen a technical break above the recent high. So on the next slide, I think I'll share on the dot plot chart. So the dot plot has been updated since June last FOMC in June. So what was the difference is between is for June. All right, actually the Federal Reserve, most of the members, the voting members are going through like 2020 is beyond 2024. They will see a rate hike. But now more and more members are jumping on the bandwagon to see the rate hike at 2023. So however, the votes was split between 50-50, 9 versus 9. With 9 out of the 9 who voted potentially voted for a rate hike, 0.25%, 6 members voted for a 0.25 basis point hike, and then 3 of them voted for 50 basis point. So I think the Federal Reserve is betting on the rate hike given the improved economic condition and the economic outlook that is present. Unemployment rate still remains at 5.2%. It's still a far cry away from the national rate of unemployment at 4.2 to 4.4%. All right. Okay, so sorry, there's a construction going on below. There's nothing I can control. All right, so sorry guys. All right, so for the next chart, okay. Federal Reserve Holdings, this is the historical comparison about the 10-year yield, and then it's about the and then the taper tantrum back in 2013. All right. Right now. Okay, so 10-year yield spike. Okay, so 2014, it saw a spike up in the tapering announcement, and then it caused a 10-year real spike up very, very high. All right. But I think the Fed has already known this mistake, and then therefore I think Jerome Powell has adopted a very cautionary approach to it. All right. So yeah, so that's it. So moving on to the next slide will be the technicals. So 10-year yield actually broke above the resistance at 1.5% last week after the FOMC announcement. Okay, so from the largest technical perspective, I think it has already broke out of the range of that, and then I think we are looking at 1.5% target in the short term. But however, I think that 10-year yield will unlikely cross above 1.5% in the immediate downturn. All right, so yeah, moving on. The next slide. So let's look at the S&P 500. Okay, so Dow's daily wave count, you can look at that is that we are not out of the woods yet, because I think if you look at after wave 5, there was a deep correction near the immediate support zone. However, we did not see any rebound from that. So hence, I think that prices is going to test at 4,500 before going down to correction to the immediate support zone at 4,156 to 4,259 before a rebound to the upside to complete the ongoing wave 3. All right, so next slide. Okay, so Ichimoku has shown that the uptrend line was broken despite rebounding from the Senko SPAC and the Kumo. Price remained at 4521 to 4546, major resistance. Senko SPAC is down. All right, and then we are going to see another correction down to 4261 support zone likely. All right, and then I mentioned earlier, upside might cap at 4521 to 4546. All right, so moving on. I think bullish for the dollar index is at a long-term bullish outlook to come. Okay, so on the next slide. So the dollar index has completed the wave C tentatively, and you can see that from wave C there's an ascending triangle formation. All right, so we are going to see above a threshold resistance to break out on the upside. All right, and then we are going to see 100. I think if it breaks this, we're going to see 100 in the longer term run for now. Okay, so on the next slide will be a daily chart. All right, I think if you see the Adam and Eve double bottom, there's a tendency for a strong potential to break on the upside. As technically has shown, Adam and Eve double bottom works 75% most of the time. But however, the threat of head and shoulder is still looming. Although we do have last Friday, there's an inside bar. However, I think that the inside bar is going to fail. We're going to see some slight correction until maximum correction level to 91.05 to 91.41 in the support zone, and then therefore we could see the upside resuming above 96 by end December. All right, so on the next slide. This is my second last. I think gold outlook. Gold correction is not over. First you look at the larger correction starts from last August, where it hit a peak of 2050. You can see there's a 333 zigzag correction down to a major support zone, and then there's an upside, and then after that there's a strong correction that rejects $1,900 per ounce, dollar per ounce. All right. If you look at the similarity, you can see that the bullish flag, there is some sort of like similarity to the wave correction back from last August to April. So yeah, we are seeing some slight correction, and then we should see some rebound at 1694 to 1659 before a strong rebound to the upside. All right. So next one will be the Facebook, which I released this morning. You can go to stocksbnb.com for more information. So briefly to talk about it, I think Facebook wave 3 of the cycle phase has not completed. So we are looking at the subwave of the wave 3 of the intermediate phase, which is a bracket 1. And then after that, currently right now, we are in the ABC, larger ABC, sub-ABC corrective wave to the upside. Resistance zone at 380 region might be capped. Then that will be forming the wave B. And then wave C, it will be either going back to support zone 1 at 333 to 340.35. And then if it breaks 313 to 319, will be a longer upside run to form the larger wave 3 of the intermediate phase. All right. Also, RSI has shown oversold region at near the below the 30 line. So if it breaks 40 by tonight, I think we can confirm the immediate upside for tentatively. All right. So with that, I end on my time. I pass my time to Paul for Starhub. Thank you.
Okay, thanks, Viren. So we released a report on Starhub. This is regarding their their 50.1% acquisition of MyRepublic. Next slide. Sorry, I know there are lots of words here, but don't worry, I'll just run through with you. In terms of the first bullet point, in terms of the recent event, what happened? So they are investing 70 million for 50.1 majority stake in MyRepublic's broadband business in Singapore. But do note that there is another 92 million on top of this if they hit certain financial metrics. But they did highlight that the 92 million is a bit of a stretch, but they did not reveal what were the financial metrics and like how much is to be paid if these metrics are met. Then the most unusual part of the transaction is this 3-year loan that they're going to extend. 74 million 3-year loan to the holding company, MyRepublic holding company. So this is not the entity itself that they're acquiring, MyRepublic Singapore, the broadband company. The third bullet point is is just an update on what is the NAV of the target that they're acquiring, net debt, EBITDA, and so forth. In terms of the positives, for us, what will happen would be after this acquisition, Starhub's broadband market share will rise to 40%. And I think this will just consolidate the market more to virtually a 2-tier market, or I wouldn't call it duopoly. I think it's like basically a large 2-tier, because Singtel will own like 43 and they will own 40. So it's almost like 80% market share by both. Another 2 operators on M1 and so they only got like less than, I think like 14%. Okay, the other benefit is just that when you acquire MyRepublic, we think that you also avoid a possible disruptor. I think if it's not Starhub, then we worry that if there's another shareholder that comes in better funded, that could even further disrupt pricing in the broadband, which is one of the growth areas right now. The other positive is, the typical every M&A, there will always be some synergies mentioned, cost synergy, revenue synergy. But again, you need to see whether it actually materializes, because every single acquisition has some synergy by the investment bankers. The other positive is that this acquisition will be financially accretive, so it will raise the EPS and EBITDA will also improve. The negatives for us is it wasn't particularly cheap. I think the EV EBITDA was 8 times, where we target Starhub at 6 times, so it's a bit higher than our own valuations for Starhub. And also, but I think it all depends whether you can capture these inverted comma synergies. The next negative is that it adds another layer of financial risk, of course, because there will be this additional 74 million to MyRepublic loan, which is backed by security packages. So I'm not sure, it wasn't disclosed to, but of course it is interest bearing. But you do raise you now become like a better kind of banker to MyRepublic now. Overall, we maintain a neutral. I think the benefit is you consolidate and so forth, but no change in our view. The attraction for us, at least for Starhub, although we have a neutral, is that you're paying a 4% yield at least, and you're paying it out from earnings, which is very depressed right now because there's no roaming, and you lose at least 20% earnings with it. So the 4% dividend yield, you could say, is like a base level. Then if borders reopen, which I have no idea when it will, and roaming returns, mainly for Malaysia and China, then you can see this big pop in earnings. But again, the timings are unclear, so it's hard for us to call a buy and when we're not clear the time. Okay, next slide. So our usual weekly, next slide. Okay, there weren't much in Singapore macro, but I think we'll just highlight whatever that some of the key macro numbers that came out. So we had industrial production. Although August was only up 9 compared to the prior month, 18, but there's all this base effect, so hard to trend something because a year ago everything was like in shutdown mode. But when we compare to 2 years ago, actually the industrial production is quite a huge jump. It's almost 30% over 2 years. So in general, the manufacturing activity in Singapore is still healthy. The next is the core inflation. I think this is more important for Sing dollar. So the August is up 1, is highest in more than 2 years, and is above MAS target for 2021 of 0 to 1%. Just to refresh, MAS policy now for Sing dollar is 0 appreciation. So this may push them, especially if the economy is growing further, to maybe raise to appreciate the Sing dollar. I mean, that's the main message from here. The next is of course US. They have FOMC meeting. I think for me the 3 key points from the meeting was they will very high chance they will start tapering in the next meeting in November. Taper means they will just buy less bonds, mortgage-backed securities and treasuries, and it will probably end in middle of next year. But I think the Fed reinforced that even though they end taper, it doesn't mean they will immediately, after you stop buying bonds, then you're going to raise interest rates. So they said this is a different set of circumstances. But regardless, I think the dot plots show that the expectations now is that for a rate hike to be at end 2022, the first rate hike, and end 2023 interest rates could, it's not jump, it's not a small number, but anyway, it could be as high as 1%. I mean, the Fed funds rate. The more worrying thing, at least the second bullet point for us, is just the Congress, the whole log jam, because there are a few things happening now in Congress. So probably politics is the big noise right now. There's going to be a 1 trillion infrastructure stimulus, and there's another, this 3.5 trillion reconciliation. But anyway, just assume the 1 trillion is like hardware, infrastructure stimulus for bridges and roads, whereas the 3.5 is more like software, I guess, is for human infrastructure, education, childcare, and so forth. In general, one way to kind of differentiate it. And then you have also this debt ceiling, but debt ceiling has always been around since 2011. So, so that risk profile is less. Just that because both these stimulus are almost coming in hand. If one doesn't get approved, then the other one won't. So without these two, then it kind of tapers down everyone's expectations of growth in the US. Later on, we'll just run through some of the 3 Phillip on the ground poems webinar. We'll just give you some highlights of the meeting. Because of so much noise on Evergrande, so we'll just give you some quick overview of how Evergrande's debt metrics compare to some of the Singapore developers here. Tactically, we are cautious. I think macro-wise, there's a lot of uncertainty out there. Of course, there's always some uncertainty, but it's just a bit more elevated this time around. Obviously, in Singapore, we have our reopening hiccup. Then, there's the Congress jam. Interest rates may have bottomed and probably likely to rise. But again, all this depends on whether you got the stimulus and not. I think if you get the stimulus, I think rates will probably might gap up a little bit more, interest rates, I mean. In terms of poems webinar, we have one more, we have one on the 30th. It used to be called MC Pay, but somehow the name now is called Oxway. But anyway, the others you can see for, if anyone is available, feel free to just register. Yeah, thank you. Next slide. As usual, we just run through how are the global cases trending. The good news is still continue to decline, and hopefully we can hit a new low, the blue line, a new low for this year, which is about 350,000, but we're still a bit way off that. Next slide. In Singapore, I think we know what happened on Friday, the announcement. But so there is a doubling, I think, that we highlighted last week. We are in the 4th doubling stage right now. So note that our cases, I mean, when you accumulate 7 days total, we used to be 1,002, then it doubled to 2,006. Then it doubled again last week to 5,000. And this week, because my 7,007 excludes yesterday's 2,000. So we are experiencing another doubling to 10,000 cases in a week now. So as the authorities kind of mentioned, we are in this fourth doubling cycle right now. Again, there's no signs of it plateauing. I think this is just for stats. If you want those like ICU or worse, is this virtually like a pandemic for the unvaccinated? Because for those who are vaccinated, only 0.13, really enter the ICU stage, or you know what means worse. I mean, the expectations is that we probably can get like 3,200 cases by next month. The reason why they kind of pulled back is that it's unclear when will this jump in community cases will peak, and they're extremely worried of the strain on healthcare because they didn't expect it to be that fast, I guess. But important to note that they've not changed the vaccinated travel lanes, no international borders. Neither have they changed the rule, the relaxation of dorm workers coming back to the community and so forth. So it's very targeted, I guess if there is a consolation. Next slide. This is just an illustration of some of the data points for your reference. You can see that electronics is the one that's a bit weaker. And this one could be a tailwind for Singapore dollar, because if the core CPI continues to hit 2, I think which is above the MAS target, you probably have in October, they'll probably announce some appreciation of the trajectory. Yeah. Next slide. Okay. We did this exercise just for reference. Okay, so what we did is just bear with me, I know there are a lot of numbers there, but anyway, that is the China Evergrande numbers. Again, this is the full year historical numbers. So this is Evergrande's interest cover, net debt, the amount of net debt they have. That means bank debt is about 116 billion. I converted to Sing dollars so you all can maybe understand it a bit more. Okay, but when we rank it against some of the Singapore developers, these are the ones. So interest cover means that means the amount of profit you have to just pay interest rates. I mean, don't talk about taxes. I think this is EBIT. So this is the amount of operating profit you have just to pay. So you can see like Evergrande is just barely covering it. Of course, some like Qian saying, I mean, these are it depends, because some of these are hurt by like the bullet point there. Some of them because of they have a big hotel exposure, so that's why the profit is down. But again, this doesn't mean that we are having an Evergrande. Just for your own reference. Net debt to EBITDA, you can just assume how many years it takes to pay off the debt. But there are some differences to note. So if you 9.5 means like 9 years to pay your debt out of cash flows. I mean, just a rough ballpark number. But the thing to note that in Evergrande, they rely a lot on trade payables. So the trade payables is as large as the amount of bank debt out there. I mean, net debt, which is not like what we have in Singapore. And of course, they capitalize a lot of the interest rates. Their interest rates is all over the place, like investment properties, construction. I think the accounting policy in Singapore is less so. And of course, in Evergrande, they got a lot of properties that have been completed but not sold. Basically, properties that they are stuck with, I guess, if you want to take it to the extreme. And in the Evergrande, the interest rates are higher. So again, this is not to say we have anything close to that, but it's just for your own reference, because we didn't go and study each and every company. But hotel was the one that kind of depressed a lot of like OUE, all this got hit by the weak hotel operations. And it is just for reference. Next slide. Okay, and just to give you some highlights of our Poems webinar with ComfortDelgro. Just pull up some of the more interesting parts, not to run through everything. So for taxis, they just mentioned that the borders do have an impact because taxi actually, when they do two return trips to the airport, they can actually cover the charge. So I didn't realize too that the taxi, trips to taxi are actually so meaningful for the taxi operators. The listing is still underway for Australia, and it's just to localize and to raise their own money. I won't run through every single thing. For dividends, they are committed to 50%, but they just wanted to remind that because Comfort is the parent company, holding co, they always need to keep extra cash buffer in the event that there's any funding opportunities. The main one for me was the downtown line. Just as a refresh, all the MRT, LRT lines are under this new, they call it NRFF, but anyway, it's a fancy term. But anyway, it just means is that the revenue, the profit and revenue is shared with the government. So if you make too much profit, the within a band, there's a cap and collar, but within a band, the authorities will let you earn this amount. Otherwise, there'll be like some additional license charge. But right now, all the MRTs are under this kind of framework. But for downtown line under SBS or Comfort, it is under where they actually have to take in all the passengers. So when there's no passenger, you take all the risk. But if you are with the government new way, where the government will share with you some of the losses up and down. So of course, if this news happens, it will be good for Comfort. So it seems that this thing should be happening, but of course the timeline. But again, the only thing is that you will just invite more competition and lower margins. But that's I guess a day two problem. Once they announce this should be positive for the share price. The other thing is just on the topic of Grab or just any PV private hire vehicle. I think their commentary was basically, it's going to be hard to compete with someone that the model is to lose money and grow. Of course, Comfort can never go lose until that huge amount. But the one thing they just mentioned was that if they do go listing, typically when you look at what has happened to Uber and so forth, once listed, they tend to refocus and try to be more profitable, I guess, and that kind of reduces their loss, their kind of more aggressive pricing strategies, because they have this path to profitability that they need to prove to the market. So this was some of the points they have. So for us, we still like Comfort, but obviously with the recent announcement where work from home is default and so forth, this will hurt Comfort in two ways. They probably need to give more taxi rebates. And number two is, like we mentioned, all the MRT ridership, no passenger, you bear all the risks. So this will obviously hurt them in the near term, but we still maintain our buy because we think the reopening is still our main recovery and reopening play with a large operating leverage. Sorry for the typo there. The table on the right is just to show you this is the structural issue that they have. I think you can see the number of taxis they had. You can put whatever number of 15,000 or 16,000. Right now, hopefully it can stabilize at around the 9,000 plus level. Thanks. Next slide. Okay, move on to Asian PayTV, Poland's webinar. So for those who don't know, they are the third largest cable TV operator, and they are the sole operator in certain counties. It's basically a monopoly in these 4 counties in Taiwan, in North Taiwan. So the main thing is that I won't run through everything, but I guess there's a rule there, just for if anyone's interested, that no one party can control the cable TV operators to 1/3. So whenever there's a news of them being taken over, you have to be mindful of that, because they already have 15%. So another cable TV operator cannot acquire and market share exceed 30%. So that's something to take note of. The broadband is doing well for them because they are bundling more plans, and then more mobile operators are working with them. There was this thing where Dada Digital, which is another cable TV operator, was supposed to take them over, but this did not materialize. But the commentary from the company is just that regardless who operates, the trustee manager is governed by the trustee, and they require, like, out of the 7 directors, 4 are independent. So regardless who controls, it really does not change the management much. Right now, they are working with Dada Digital just on their expertise and so forth. On the 5G backhaul, which is the one of the other share price catalysts, which is a totally new revenue driver for them. They mentioned that 2018 they have 0, now they have around 1 million revenue. And because the 5G operators in Taiwan need to be prudent after they spend so much on the license, this will eventually happen. They're still confident. And even when they turn on this broadband 5G, there's very little incremental capex. So the drop to profitability can be high. And in terms of the dividends, I think right now their yield is 1 cent over this 13 cents. So for me, I think it's like 7% to 8% yield. That they will decide on the FY22 next year's dividend in the next results. And the chart, as usual, I mean, we always show this chart in our presentation, is just to show you in the early years when they got listed, the dividends was not sustainable. I can see the red line. They used to pay like 100 and almost as much as 140 million dividends, but the real free cash flow was only 30 million, and this only in 2019 you see the red line suddenly gap down where they just slash the dividends, where it's become more sustainable for them based on the cash flows. Next slide. Okay, this is my last one. So this was another company that presented in our Poems webinar. Okay, so Qian Hu, some of you may know, but they are famous for their ornamental dragonfish. So what their main business has been ornamental fish. So they trade like 1,000 varieties of freshwater ornamental fish, and they apparently have like 5% world market share. Okay, what they do is actually they trade. So they don't really breed these ornamental fish. I think they said only the arowana. Most of it they probably from breeders in Malaysia. Then they will just buy from Malaysia and then just export it to all over Asia and so forth. I guess the key or the expertise here is these are live fish. So you need to have the expertise and logistics to keep the mortality low. I think they say like 5% only there for their mortality. And it is doing well apparently because demand for pets has been, there's been a surge in demand for pets since, I guess, we all start at home. So the new growth area for them is aquaculture. So the two main products is freshwater prawns. I think those giant freshwater prawns. And what they're doing now, the model is that they will, I think you can see from the table on the right. So they will fries, they will breed them and then they will send it over to the farms in Malaysia, because these are big enough. So they're working with 16 ponds in Malaysia, and then the first harvest will be fourth quarter. The plan is eventually to sell this to restaurants, and I am just to bore you with this detail, but I mean the restaurants will buy and put it on their menu, so-called, because if they can get this regular supply. So of course, when you sell live, there's better margins, higher price, and so on. Then the next one they're going to do is Vietnamese shrimp. I think those who go to Sheng Siong supermarket can see all this. But most in the supermarket are frozen and thaw. So what they're going to do, the interesting thing is they're going to farm it in Singapore, and their yield can be 10 times higher than traditional method. But I guess they have to, right? So such a small area. But what they're doing right now is a pilot trial. And again, they're also going to sell a higher price. There's a lot of technology here because these prawns, shrimps, right, are subject to a lot of disease, and that's why and this is in line with the government, not the 30% food source from in 2030. The other one is just a minor thing. It's just that they are doing also fish in China, but in a very small scale. They're not, it's more like selling the fries. But anyway, this is whether it works, I have no idea. But this is just to share what is their growth plans and with the new business that they're entering, which is the aquaculture. Okay, I think that's it for me. I think we can move on to Q&A. Thank you, everyone.
Hi, I'll take the question on Facebook by Michael. Seems FB has a bad boy image among the mega techs. How this problem will affect its business performance? So actually, we're not actually that concerned about. We're less concerned rather about how Facebook is viewed by regulators in the US and around the world, because most of the times, whatever happens, they just end up getting slapped with a fine, which doesn't ultimately affect their business. Take, for example, Microsoft's antitrust case back in '98. Nothing really happened to them. It's just very inconvenient. And actually, Facebook and a lot of the other mega tech companies have used Microsoft's antitrust case as a case study to prepare for whatever regulators may come after them. We're a bit more concerned about the third-party changes with Apple and how the changes to their iOS would directly affect the efficiency of Facebook's targeted ad. Thank you.
Natalie?
Hi, I'll take some questions first while I continue to compile the rest of the questions. The first question I saw or caught my eye was the question about CapitaLand's announcement of the acquisition of hyperscale data center assets in China, which will be completed in the third quarter of 2021. So the question is, where will these assets be injected into, CLCT or one of the CLI private funds? Okay, so just to note, usually developers only inject stabilized assets into their REITs. So what does stabilized mean, and why do they only inject stabilized assets? So for stabilized, the stabilized assets means assets that have achieved a certain occupancy level. Usually it's in the 90s, maybe high 80s, 90s. That would be, you know, the gold standard of stabilized. And for data center assets, it's a little bit more special in the sense where even though the asset may have space or you know, committed, the peak of the revenue, or rather the contribution of the client's revenue, will not peak until, you know, it could be a few years later, because for some of the tenants, they usually take on, when they do their space planning or their data center planning requirements, they will take on space enough for maybe 3-4 years of growth. So that means that at day one, the amount of the utilization rate of their space is actually relatively low. So as time progresses, as their business grows, expands, then, you know, they will rapidly ramp up the usage within the space in the data center. So therefore, that means that, you know, the asset might not be actually providing the best yields presently. So for this data center, the one that was acquired in April this year, the China data center, this asset is also relatively new. So in terms of operationally, they are relatively young. Okay, so it will take some time for the asset to be stabilized. And of course, CLI aims to monetize their assets on their balance sheet within 3 to 4 years. And it can be sold either to the REITs, their own private funds, or third party. So it really depends on whichever brings in the most value for the shareholders. Yeah, so I hope that answers the question. There's another question on Ascott as well as Suntec. So fundamental analysis for Ascott and Suntec, please. Separately, another question: are you aware of any recent developments that could explain the share price of ART hitting the low of 94 cents today? Okay, so for Ascott, we actually feel quite positively about Ascott. This is because of their recent acquisitions into the long stay asset class. So of course, which is the purpose-built student accommodation, PBSA for short. Yeah, so we feel that this you know, acquisition, this a larger stake, because Ascott does intend to grow their stake in their exposure to long stay asset classes from initially at the start of the year was about 7%. 5%. So now they are around 7%. Now they are from 5 to 11%. Yeah, and they intend to grow it to 15 to 20%. So this a larger exposure to these long stay assets basically adds some stability as well as income visibility for Ascott, which, you know, as the pandemic has clearly highlighted, the hospitality industry is, you know, susceptible to these kind of pandemics, and, you know, of course, movement changes in hospitality, or rather travel demands. Yeah, so just to add a bit more stability to this hospitality portfolio, this long stay asset is considered, in our view, is very positive. Yeah, and because of its counter-cyclical, or rather very defensive nature of these long stay assets, the rental housing, which is meant for people who are living in, for example, Japan, where they live in one state and they work in another state, so that they actually sign long leases of 1 to 2 years. And similarly for PBSA, where, you know, the school term, usually the leases signed are yearly, so it's 1 year kind of leases, so that actually provides income stability. And we are of course, another part about Ascott is that, you know, they hold a global portfolio. They have exposures to China, Japan, Australia, and also the US. So France fronts as well. So because of their exposure to these countries with very large domestic travel markets, even though globally we're still seeing that most international travel lanes are still closed, we expect that Ascott will be one of the first names to recover, especially because of their large domestic tourism market. So domestic tourism will pick up before international tourism. Yeah, so for the second part of the question, which is, are you aware of any recent developments that could explain the share price of Ascott hitting a recent low? I think that for all the names, for all the hospitality names, you actually see that at the start of September, that's when the share prices started to come down a bit more, a bit more obviously. Yeah, except for Far East Hospitality, which the share price actually showed a reverse. It actually climbed at the start of September. So we think that this could be due to the spike in COVID cases globally, and a bit of nervousness. So basically, it could be that investors are actually thinking that the recovery timeline will be further pushed back. Yeah. So if you look at the hospitality REITs, so Far East Hospitality would be a Singapore focused REIT, and 100% of their leases are actually on fixed master leases. So that means that there's a fixed portion and there's also a a turnover contribution. So that means, I guess, in a sense, you can say that Far East Hospitality, there's a real solid base of income for them. Yeah. Okay. For Suntec, we do not cover Suntec. So their portfolio of office assets, as well as they own a Suntec, the mall, which is Suntec City Mall, and also a very small component of it, which is the convention center. So I think that the office assets, or rather the office assets within Suntec REIT, they're also facing the kind of headwinds that all the other office assets are facing, meaning to say that leasing is still a little bit soft. There's still quite a bit of competition for space, competition to lease out space within the office sector. As for the retail side of things, the retail malls, especially those in the suburban area, in our view, we think that there's still a bit of softness there. We expect that some of the leases that have been, from the management, what they're sharing with us is that, the footfall has increased even during the weekdays. However, of course, I think with the spike in community cases, that might also be pulling back a little bit. Yeah. In general, I think that for the retail side, especially for the downtown malls, especially with the leases being renewed on higher risk sharing structure, meaning to say that the REITs have lowered the base rents and simultaneously increased the gross turnover rents so as to achieve some sort of profit sharing between the landlord and the tenant. We think that because of this, the downtown malls will actually still be under pressure. So not that positive on for Suntec REIT. Yeah. Okay. I'll hand the time over to the rest of my colleagues while I check out the rest of the questions.
Yeah, thanks, Natalie. I'll take the next few questions that are the highest voted in order. So I'll just go by order. First question, will bank shares like DBS be dragged down by the Evergrande scandal in the near term? So I think this one is talking about exposure. I think if we talk about Evergrande saga, this will have huge macro impact, and then this will drag down other shares also, not just DBS. But in terms of, I think your question may be about more direct exposure. At this moment, we don't see any direct exposure that DBS have to the Evergrande scandal. I'll move on. Sam Marine rights, any chance to sell the rights? So maybe a little bit more background. The Sam Marine shares, the rights issue has been completed, but the Sam Marine shares have now received a compliance offer from Temasek to acquire the shares at 8 cents a share. So this is a compliance offer because the reason why they have to do the compliance offer is because of Rule 14 of the Code on Takeovers. So they don't intend to actually take over the list, take the company private. What they're just trying. What the rule requires them to do is, if they own above 30% of the shares before the announcement, less than 50%, if they go up by 1 percentage points within 6 months, then they have to make the compliance offer, which is why we have this 8 cents offer now. So because the offer by Temasek is really more academic in nature, just following the rules, and the current share price is higher than the offer price. If shareholders want to sell, of course you have to take into account brokerage and everything. But if shareholders want to sell, they could get a better price in the open market now. Of course, also do look at do calculate your own brokerage before you make the decision on whether to sell the rights. Okay, I'll move on. UOB and OCBC, please hold or sell. Currently, our rating on UOB and OCBC is accumulate and buy. So we still continue to recommend investors buy and accumulate the shares. We are still bullish on the longer term prospects for the group because the loans growth is still expected to grow by high single digit. We kept that unchanged. The non-interest income also expected to grow by double digits for this year. And also we expect to see some of the reversal in the general provisions in the second half of 2021. So our outlook of the banks, UOB and OCBC is still positive at this moment. Nothing has changed. Yeah. Sembcorp Industries going forward, comments please, thanks. We currently have a neutral rating on Sembcorp Industries. Our target price of Sembcorp Industries is $2.01. So the reason why we are neutral is because we expect the second half of 2021 to be slightly weaker than the first half of 2021. This is because there are a few reasons why. The first reason is because we expect higher downtime in the second half of 2021 because of maintenance. These are scheduled maintenance works. The reason why we have even higher downtime was because in 2020 they didn't manage to have so much maintenance because of COVID-19. So a lot of these scheduled maintenance got pushed to 2021, and now they're going to do most of the maintenance in 2021. So in the second half of 2021, so with that scheduled downtime, we expect earnings to come down. The second reason is because the renewable energy in India is expected to be a little bit more constrained. Construction activity in India also expected to be a little bit constrained. So energy demand in countries like India is expected to drag their earnings down for the second half of 2021. So in terms of our forward view of Sembcorp is a little bit weaker at the moment. So we are neutral on the counter. Yeah. Let me just go down and see if there's any more. Okay, please give your views on Keppel's offer for Sembcorp rights. Is it practical to accept in consideration of open trade sale of Sembcorp shares? So I think just to clarify this comment, the offer for Sembcorp's shares is not for Sembcorp's rights. The offer, what we understand now is that the current offer for Sembcorp shares are from Temasek, and it's not for the rights. So it means if you own the shares, you can actually tender to Temasek. It's not the offer is not from Keppel. So what this trade, like what I mentioned earlier on in response to an earlier question, is there is a compliance offer that is required under the Singapore Code on Takeovers to make a compliance offer at the highest price which they acquired the shares in the last 6 months. So that's 8 cents for Temasek. So they have put out their offer now. And if shareholders wish to tender their offer to Temasek, after taking into account brokerage costs and everything, then they can do so. But because, like what we say, because the current share price that is trading in the market now is higher than the compliance offer. So they may, if they wish to sell their shares in the open market, it may be more practical to do so. Okay, I move on. But if I didn't answer your question, please just let me know. Because I'm just trying to guess the question from your question. I think that may be all for me, but just yeah, that's all for me. I'll hand over to the rest of my colleagues. Thank you.
Yeah, okay, let me just take this. Okay, not sure what happened to my camera screen, but let me try and fix this. Sorry if I okay, let me just turn on my video. Sorry, something wrong with it. Or the background. Okay, sorry, so your
hello, Vivian here. So maybe I'll just take the questions on Fortress Minerals and Southern Alliance. So still not much change in our commentary on Fortress Minerals since updating, I think, about 2 weeks ago. So basically, it has been tracking the iron ore futures still quite closely. And the iron ore futures, I think, quite dependent on the expectations on China's steel production levels. So we have seen over in the news on how the Chinese government has been restricting the steel production levels quite in a quite strict manner. So even though for the first 8 months of this year, the production has already decreased about 12%, and they are for the month of August, the production decreased by 12%, but for the first 7 months for this year, from January to July, the output was an 8% increase. But the Chinese government mentioned that they are planning to keep the 2021 levels unchanged. So according to Bloomberg consensus, analysts are expecting that the Chinese government could implement even harsher curbs for the rest of the year. So it has been falling since May, and we think that it could fall more to a higher extent for the rest of the year. Yeah, and a few reasons for this steel production curbs including the reducing the pollution, and also the Sino-Australia geopolitical tensions. And recently there's this, of course, as we have seen from the Evergrande scandal and the tightening of China's property market, which could impact the steel demand in the long run. And I think for Southern Alliance, they recently released their FY21 results just last week. So we see that for production levels wise, the total production fell, but so they have something different between Southern Alliance and Fortress Minerals is that Southern Alliance, other than iron ore concentrates, which is the main product that Fortress Minerals sells, they also sell crushed iron ore, which is a byproduct of the production of iron ore, and also iron ore tailings. And they have seen quite a large decrease in the sales level, and we think that I'm not very sure about the reasons, but probably we'll share more after their briefing next week. So the sales volume for iron ore concentrate was around an 8% increase, but given that their year end was in July and the iron ore prices started falling drastically since August. So it fell from around 200 to now about 110, 120. So even though you get a 10% increase in the production volume, but if the sales prices, the average selling price decreased by more than 50%, then that would still hit their revenue. Yeah, so probably we'll share more after the briefing next week. Yeah, so that's all that I have for the fundamental analysis. Yep, thank you.
Okay, thanks, Vivian. Let me just try and answer this question all in one go. Let me just read it out. Hi, Phillip. Without being constrained by research agenda of today, can you give us your gut feel 3 to 5 top SG picks big or mid cap over the next 3 to 6 months. My sense is the weekly session is more like a rehash of PSPL's old ideas and standard picks, albeit some fine tuning. For very stable like ours, usually very little developments over 1 week for individuals. So we need fresh investment ideas, more spontaneity. Yeah, I mean, thanks for the feedback. I think it's very useful. Sometimes we are constrained to, of course, don't talk about the Singapore market alone. We cannot be that spontaneous because we are licensed, so we cannot just. It's very, very hard for us to just pull out some names and without like proper basis and everything, because we are really scrutinized very tightly on what we recommend. But let me just say, since you want so-called trading, I guess the one thing that caught our eye at least is Olam. So just for those who don't know, again, this is not a recommendation and thing. That's why we're always very constrained, because we cannot mention anything unless we got like a report with all the report. Anyway, there is a view there that because Olam is going to list all their operations on the UK stock market, basically everything, then they will dividend in specie all the units to Olam shareholders. Although the valuations is not concrete, but there is a possibility that the combined valuations could be higher than Olam's, I think, market cap now, I think 6 or 7 billion Sing. So if we have time, maybe next week we'll just share a little bit more. But there is one trading idea that's going out there. The listing could probably happen maybe early next year. Yeah, but not to mention, I think like Olam results are doing well. So all this combo of events is helping the share price. So as you can see, even if I use this, we are very constrained on what we can say. If you took a buy, we've got to come up with a report, justify the valuation, line by line, and what can go wrong, show you the risk and everything. So there is virtually no spontaneity from us because we cannot give you spontaneous answer. Unlike maybe a blogger and so forth. I hope that helps you. Yeah, in as spontaneous as we can be. Natalie, I hand it over to you. Thanks.
Thanks, Paul. Okay, I'll take the question. CapitaLand, about CapitaLand investment management. Yeah. Okay. So, I think some of the attendees would like to know my comments about its potential, and if you recommend to buy now. Okay. So for CapitaLand investment, yes, overall we still feel that this counter is poised to deliver good results. Of course, for those of you who have been following CapitaLand, we know that this has been a relatively, in terms of big picture view, they have been very committed to the things that they set out to. So for this new entity, I think about half of its balance sheet will be backed by investment property, and the rest of it will be, of course, the fund management business. So of course, the management of the REITs as well as their private funds. So currently, by 2024, they're actually aiming for a fund under management. Total fund under management of $100 billion. Currently, they are about 77 billion, and the bulk of it, about 52 billion, is actually from the listed REITs. Okay, so of course, the one that is lagging behind and where there can be more growth will be the private funds, which of course there is certain liquidity and appetite chasing some asset classes within the real estate sector. Yeah. Okay, so with that, I think the last week we had a media analyst kind of briefing, and the management team actually introduced 2 new positions within the organization, which is targeted at growing this private fund business. Yeah, so of course we can expect some growth from that point of view. Apart from that, they also have their lodging arm, which is the Escort Limited. So the Escort Limited is actually they're positioning it they are positioning it as a asset-light kind of business model, where what they want to do is get franchising, sign franchising agreements, and as well as the management of these service apartments, service residences, without actually putting in the capital to buy the assets. Yeah, so of course, in 2020, you would think that the hospitality sector is not doing well, but with regard to the service residences, which is sort of a subset of long stay asset classes, the signing rate for new franchising management agreements has actually outpaced the period last year. So in 2020, it was actually a high for the signing of these management contracts. I think about 14,000 keys were signed. So for the same period, January to September this year compared to last year, they have actually outpaced that signing by about 20%. So in a nutshell, we think that because of their very focused and very, a more sharply focused kind of agenda going forward, there is potential for CapitaLand investment. Now with regard to the target price, so regretfully we haven't yet released our report on CapitaLand, so I can't comment on the target price. Just to give you guys a bit of perspective as to where other analysts are seeing the target price for this counter, it ranges between $3.60 to $3.90. Yeah, so regretfully, I won't comment on my share price because we haven't released the report yet. But this is the range that other analysts have given CapitaLand investment. Yeah. As to whether or not to buy now, I don't know whether we wants to take this because it has a relatively short trading history, and technicals might not be very easy to discern a technical trend. So I don't know if Wei wants to take this. Sorry, very, very quickly, let me just take the second question, which is Mapletree Investment has recently closed its US property fund. Can you share insights into the potential implications of this move? Okay, so for Mapletree, just to give some background for those who are not too familiar, they raised about $552 million for this fund. I think it's a private fund, meaning that it's not listed. So the assets that the fund holds, they are located in Oakland, Raleigh, Dallas, and Minneapolis. So these are all states in the United States. And okay, so with regard to the kind of assets that they will hold, especially for like Raleigh, Dallas, these are markets which I think there's a great tech presence, and therefore, as mentioned before, the tech tenants are the ones that are, they are the better rent paying masters in a sense. So they are the industry that is experiencing growth and etc. So of course they will be more, they are more willing to pay higher rents or better rents as compared to the kind of industries like your banking sector, your law firms. Yeah, so the tech and biotech kind of industries, yeah, these are the ones that most office landlords would like to capture these tenants, yeah, for the fact that they will provide better rents. Yeah. Okay, so with regard to this portfolio, 8.8 years yield, I think in general, I would say that even though the office sector does face some headwinds, especially in the US, where we know that the vacancy rate is actually really quite high, about 17%, there is still pockets or pockets of which are sweet spots within the country itself. Yeah, so some of these places include Raleigh and Dallas, yeah, where there is more concentration of tech and biomedical kind of tenants. Yeah. So I think overall, if you would like to draw parallels to see how this impacts our Singapore US office REITs, I would say that for the US office REITs, Manulife, which has a tenant base which is more focused on your banking as well as your legal tenants, meaning your traditional kind of office tenants, their portfolio is facing a little bit more headwinds in a sense. So that compares, of course, to the likes of your Prime and your Keppel Pacific Oak, which in our view, they do have a greater exposure to these kind of new economy tenants, as I've mentioned earlier. Yeah, so those are the ones that are expected to provide greater rental growth. Yeah. So in terms of these three US office REITs, we only have coverage on Manulife as well as Prime. So our preference is Prime within these two. But of course, Keppel Pacific Oak is also a relatively strong contender, and when it comes to this rental growth. Yeah. Okay. So I think that's all for me.
I think I'll take on the question on CapitaLand Invest. So I think Natalie mentioned just now about her views. Okay, so I mean there's not a lot of trading data going on. So I go based on the hourly chart, right? We can see that this is the completion of the wave one of the upside since last, I think it was last week, yeah. And then there was a rebound, and then goes up, and then retests $3.50 and $3.51. The hourly harami, okay, has formed, and then after a lunch break, we will see how is it going to be like. Whether it's going to be a downside or it's going to break on the upside. But most likely there'll be some slight correction towards the support at 3.28 to 3.33. So you're looking to enter for a long position. I think this position will give you a better risk to reward ratio going forward. All right. Judging from the wave theory perspective, this A, this may be B, and then C may be this, or it may go lower at $3.20. We are not sure. I think for the next one, I think Yang Zijiang, someone asked, so I saw some interesting perspective. Yang Zijiang, like I mentioned last time, Yang Zijiang has completed its wave 5, 1, 2, 3, 4, 5 waves. So we are seeing some sort of like a correction down to the deeper correction to 1.08 to 1.14 support zone. Of course, means that 1.34 to 1.38 is likely to be broken, given a strong selling momentum today at the immediate resistance zone. All right, so that's all for mine, and then I shall pass my time to Paul or Terence or Natalie for further comment. Thank you.
Okay, thanks. Let me just try to clear some of these questions. I mean, we don't have coverage for some, but let me just share as much as we can. Hopefully, it can help you. Okay, I appreciate your comment on Wilma and Yang Zhejiang, and also Yan Lot. Let me just explain. There's one overriding theme, one overriding situation right now. There's a windfall tax issue right now in Malaysia. So the windfall tax, okay, don't ask me the rationale or justification, but there is a windfall tax, and they're going to target on the rubber. There's proposed possibility to target on the rubber gloves. Even the banks can be affected. Even the plantation companies can be affected. Even the electronics companies can be affected. So that's why, I mean, if you look at the Malaysian market, some of the plantation companies are trading at lows, not to mention the rubber gloves. So again, this is not concrete. This is not a firm thing, but this is a bit of an it's a bit of an overhang for some of these stocks. So that's the one for Wilma. For Yang Zhejiang, I guess the whole situation in China, as you know, Yang Zhejiang, there are two parts of the business. It's not just a shipbuilder, it's a shipbuilder come bank or finance company. So the situation right now, as you know, the tight situation and all the uncertainties over real estate, I think that will be the part that's plaguing it down. And I don't think, I'm not sure which investor want to buy to go and to write the container business at the same time. You got a lending business there. If you want to play Mercedes, go Hong Kong or Wan Hai or even MERS and so forth. So I'm just worried that the momentum there might kind of might have been lost for Yang Zhejiang because of this whole tighter credit tightening and crackdown on property. As you know, Yang Zhejiang does a lot of financing there. Okay. For Riverstone, Wilma and Riverstone, Goner, I mean, not sure Goner, but the one issue for the electronics and also the rubber glove makers is that in the third quarter, we worry the third quarter numbers might be a bit more weaker because in July and August, I think July and August, as you may recall, there was the heavy MCO. So the electronic companies and the glove makers might be a bit affected by production because EMCO, basically you have to shut down. And even if it's MCO, you can only operate 60% depending on the vaccination levels. So I just worry the third quarter numbers for those who have operations in Malaysia might be a bit more sluggish. Again, we don't have transparency, not that they whisper to our ears, but that could be a bit of a headwind when the third quarter numbers for anyone who has operations in Malaysia. In general, I mean, just generally speaking, so that could be the headwind. Appreciate your view on landlord. I think landlord is like any typical real estate company. Yeah, the whole crackdown and so forth. That's as much as we can cover because I don't really look at. Let me do this last one before I hand it over to the rest. SPH should sell now. Okay, SPH, just for info, will do another webinar with us to explain the privatization deal. But just to refresh, I mean, if you all have the chance to attend, do ask this question on my behalf because, as you know, the deal is about $2. They will give you one, I mean, just roughly, 70%, no, 60, 70 cents in cash, roughly 70 cents in Capital REIT shares, and 70 cents, I mean, one third in SPH REIT. Right now, the value is about $2. But the curious thing is that they are actually giving the SPH REIT, which belongs to SPH. So I'm not sure why is that an offer, because it's giving back something that I already own and call it part of offer. So that part, I'm a bit curious how they come up with that. So for me, I think the value for that is a bit low. And if you want to be like really curious about it may not actually be even $2, right? Because they're giving me SPH REIT shares as a SPH shareholder. I already own the shares. So why is that part of the offer? But anyway, if you take all these three on paper, it's above $2. So for me, my own view, we don't cover. I think there's still a lot of value for SPH to unlock, even if the deal doesn't go through, because they can still do a REIT on the student dorm business in the UK. Yeah. Again, these are all our views. So do note that we don't have any coverage. We're just giving our own views here. Target for Singtel. I think for me, Singtel looks a bit. We have I think 252 target price. I think telcos look a bit more positive because what we see for Singtel in Australia and even in Singapore, prices are beginning to creep up, which is very unusual. I mean, mobile price always been like falling for, I don't know, forever. But I think ARPUs for mobile price has been creeping up. And as subscribers go on to 5G, it's a bit, they manage to creep up their ARPUs when subscribers move on to 5G because of the extra data. Whether this will be competed away, I'm not sure. But we are a bit more positive on telcos because it seems like they've been sold down and kind of bottoming out. And the competition has been a bit more softer, I guess. And also you get this optionality where if the borders reopen, you're going to get a big gap up in revenue from roaming revenue, like I mentioned earlier. So again, these are just our initial thoughts. I'll move on to the rest. I think if anyone got in view of time, SGX and so forth. Okay, let me just take this last one. Is it on venture? Yeah, hi. I know you cover venture. A good call to maintain a non-consensus target price 1920 post result. Your concern on supply chain bottlenecks warranted. Any view on another OEM, Aztec Global? I think for Aztec Global, for me, I mean, my own views it looks like it's a good stock because they've got Amazon as a customer, and I think we mentioned before, Amazon controls the platform and they're selling their own products in the platform. So obviously they have a very strong advantage if they sell because they know the best price, the best selling product. My only thing is just that maybe investors want to, because they just got listed, they just a bit concerned that their exposure is just to one major customer, and also they just like there's little clarity on FY22. So I'm just thinking that maybe after the results is out, fourth quarter results is a bit away, then maybe people get more comfort that that this is not just a FY21 story. But again, we don't cover, although we do speak to them quite often. But this is just my thoughts, because they are below their IPO since 128. And do note that this is a net cash company. So I think I think it's an interesting and fundamentally strong company, but I think maybe the market just wants to see how they fan out in FY22, because FY21 is very well flagged out with their strong order books. Again, these are just my initial thoughts. So I think I myself very curious why it's still below 128 IPO price, since there shouldn't be any natural seller at, below IPO price, right? Because most of it is locked up by the major shareholder. Yeah. Okay. I hope that wasn't a really good answer, but I mean, this is as much as I can do. Anyone else can? Okay. The next one. Let me just try. Qian Hu business model seems like moving from ornamental to food source. Yeah, that is definitely that is true. And obviously, when you're going to seafood, for consumption, obviously the market is bigger than ornamental. I mean, the curious thing for me is that they got 5% market share of global ornamental, but the profitability is so thin. So I'm not sure how profitable this ornamental business is, but it's obviously a positive that they can go into a larger business where it's for food for consumption. But they are almost like a startup in that sense, because they don't have much of a track record. So it's something to monitor, and it's interesting because this is multiple times bigger than ornamental. Yeah. So it's something more like to monitor, because how are we to know whether their ability to commercially breed tiger prawns or freshwater prawns works? I for sure have no idea. So again, for any other investor, just have to monitor it rather than yeah. Okay. Yeah. Anything on Terence, you want to have? Okay. Okay. Let me just go through for this one. What is the repetitive energy coal stock in SGX? I'm not sure what's repetitive, but the coal stocks is Golden Energy and Golden Energy and Geo Energy. I think we mentioned it before. I think if you look at Geo, the PE right now is on paper, at least I think it's only at 2 times PE. Yeah, and I think the coal prices continue to rise, so their third quarter numbers should be still very strong on paper. Again, we don't cover, but I think there is momentum in the, because coal prices continue to rise. Yeah, so these are the 2 main stocks for coal. Yeah. Thanks. I'm done, Terence.
Yeah, thanks, Paul. So I think the next few questions. There's one question here. Apologies. Time to buy UOB price. At this moment, our rating on UOB is also unchanged. Our target price on UOB is $29, and we have an accumulate rating on UOB as well. So for UOB, like what I think you may have missed the front part, but for us, the thesis on UOB remains unchanged. The current macroeconomic outlook is a little bit unstable now because of the surge in the COVID-19 cases, but the company has maintained their outlook for loans growth. The loans growth is still expected to grow by mid to high single digit, and the non-interest income is also expected to grow about double digits. We forecast about 22% for the full year of 2021. So there's no change to that. And of course, because of the significant provisions that they made in 2020 rather. So they expect some reversions in the second half of 2021 if the economic outlook improves as well. Of course, one major catalyst for the banks, I think we got some questions on the banks today, is the potential distribution of a special dividend. Unlikely to be this year, but the banks have not ruled out the distribution of a special dividend when the macroeconomic outlook improves. So that we believe could be the next catalyst for the banks. I'll probably take the last question unless anyone wants to chime in. Appreciate any views on SGX. We also have an accumulate rating on SGX. SGX, the main overhang on SGX now is because MSCI, rather Hong Kong Exchange announced the tie-up with MSCI to launch the China A50 futures shares. So the China A50 futures shares is a very big part of the contribute a very big part of revenue to SGX. They don't give a breakdown, but we estimate it's about a quarter to 30% of their overall revenue. So the belief is that with Hong Kong Exchange launching the MSCI China A50 index futures, then some of the volume that traditionally goes to SGX will actually be diverted to the Hong Kong Exchange, and that would drag down the overall derivatives value and volume that the Singapore Exchange get. We did caution in our report also that this will take time in terms of the launch at the Hong Kong Exchange side, in terms of whether they are able to ramp this up. And we think that when we look at traditional contracts, this will take about 3 years to 5 years before they can launch it up and have sufficient liquidity for institutional investors to want to trade there. So it's not like the next 1 or 2 years you'll see the volume all go to the Hong Kong side. And then of course the challenge for we have seen some precedents when the Taiwan index futures, the MSCI migrated, we moved to the FTSE, the SGX moved to FTSE, and they managed to make up for the volumes here as well. So there are different factors at play in terms of whether the investors trade the index futures. So our rating on SGX, we downgraded the price also, but we still have an accumulate rating on SGX. Yeah, so I hope I answered your question, and I think that's probably all from me. Paul, is there anything else you want to add?
Yeah. Okay. And we just one last one. I think we got the comment there on the so sorry, we can't answer every question. Just that there's one more on the comment on Yang Zhejiang. Yeah. Again, the debt is only 1/3 is property, but again, you know, there's just a lot of uncertainty there. You always worry. Of course, you can speculate. There's always this thing on the contagion and whether this could spread to other property developers or that they might be funding. Again, this is all speculation. But I think for me, the other key thing is that this stock ran up because of the whole jump in container freight rates and the huge order book. But note that their order book already doubled this year. And the news over container rates rising is, I think probably the market already kind of knows that the container rates are already up there. So I might just worry that a lot of the upside or news flow has kind of already been priced in. And you can't wait for results. I know these stocks, they run on the strength of the order books, which already doubled this year. So that's my only worry. It's not just the thing that a lot of the positive news might have already been like inside a stock, but again, like who knows, right? But that's my only concern. Yeah, we all know that container rates are already 4 times. They've already kind of reflected in the order books. Yeah. Okay. Anyway, without taking any more time, I think because Viren has a 1 p.m. I know there's still some questions here. For the slides, I think you might have to send it to us. Yeah, there's also an audience analytics. I think you got to send us an email. We will try to reply to you. Because we got another Viren has. So with that in mind, if you want the slides, anything, you can always send you a PDF and you email to us and we'll send it to you. So with that in mind, thank you everybody for your time. Thank you for all your questions. I think it were all very interesting ones. And apologies if we couldn't answer everything. With that, I wish everyone to stay safe and have a good week ahead. And hopefully we can see you in our webinars and also in our next meeting ahead. So thank you everybody. Take care. Bye.